Thanks, everybody, and thank you for joining us. Hope everybody had a great night last night, and we're going to have a strong finish to the conference today. We have a lot of good information to share with you, and obviously a star-packed panel of some of the top acquirers in the industry. So glad to have everybody join us. Thought it would be good as a backdrop to take a look at some of the M&A statistics from the industry last year, just to give a sense of what types of deals are happening out there. And I apologize in advance if we miss a deal. If you're with a company and you see that we have a short number of deals that you acquired last year, please reach out to us afterward. This database of transactions is constantly evolving. It's very complicated. We collaborate with ProSales on keeping it up to date, but it's only as good as the information we get from the buyers out in the market. So please point those types of things out. So we look at deals and M&A activity in two different ways out in the market. We first want to look at it by sheer number of deals, where every company is one deal, whether it's a $12 million lumberyard or a $1 billion company, one deal per company. And so taking that view, the top acquirer last year was Gypsum Management and Supply that we heard from yesterday, and they did 8 deals. And in total, in the market, we saw 51 deals in the LBM space that would be of interest to folks in this room. So just about a deal per week done in the industry. It was down just a little bit from last year. In 2015, we saw about 60 deals. So we're down a little bit, but still an amazing pace of M&A activity, and one that would be tough to match in almost any other industry segment. So some very active buyers out there in terms of total number of deals. The other way that we look at deals is by locations, so that when you have a big deal like an ABC Supply buying an L&W Supply, that doesn't just get one measure counted. You get a count for every one of the locations that's acquired. And so when you look at it from that standpoint, there were about 400 locations acquired last year. ABC Supply Foundation and obviously from our panel, US LBM and Building Industry Partners were among the more active buyers last year, and with the remainder of the deals rounding out among 14 groups that bought one company each. So then we start to say, well, what types of companies are buying other companies out there? And so if you look at it, and just in a broad brush approach of saying, is this a broad lines distributor that we classify as a lumberyard, or is this a specialty dealer that sells sort of one narrow set of products that they're focused on? And about half of the buyers last year were specialized, and about a third of them were lumberyards that did more broad distribution, and then the others were, a smattering of manufacturers buying things or private equity funds, things like that. So that's sort of the mixture out in the market. And again, when you take a look at the specific types of buyers, and it's difficult to categorize groups, you'll see some stats here that you might look at later and say, well, gee, I wonder what the difference is between specialty dealer exterior and specialty dealer roofing. Well, roofing means that they're almost solely focused on roofing. They might do some other ancillary products, but they put their shingle out there to the world as being mostly focused on roofing. If it's exterior, then that means they probably do roofing, siding, and windows, or any two of those three. So they've taken a definite stance in the market more toward the total envelope, not just one specific product segment. So there is some subjectivity to this, and that finds its way into the numbers, but directionally it's interesting to know where are the deals getting done. And as you can see, drywall and roofing are areas that are very active right now, and we would anticipate those would continue to be active. So then we look at sort of the sellers. Who are these sellers? And there's even more of a preponderance on the specialty side among the sellers. Almost 2/3 of the sellers were specialized, again, in a more narrow focused set of products rather than being a broad lines distributor, with the other quarter of deals being lumberyards that were more broad lines based, and then manufacturers, and I saw a couple that were hard to categorize. So then, again, digging into that by specific seller type, and Craig will make all these slides available, so don't feel that you have to write any of these down. Again, specialized aspects of drywall were very strong last year, but still a very solid level of interest in lumberyards being acquired, which means that right now, basically, anybody that's either specialized or in a broad lines sense, there's an active market out there for companies of those type. Both types of deals are getting done right now, which is good news for the industry. So with that, we'll go ahead and, if I could ask our panel to go ahead and introduce themselves. We've got 4 great panelists up here, very active in the building products industry. And if you could just introduce yourselves and your firm and give us just a brief sense of your acquisition background in terms of we've done X number of deals since such and such a time, or we're focused mostly on acquisition, some on greenfield. Just give us a sense of who you are as buyers out in the market. We'd appreciate it. And Matt, we'll go ahead and start with you.
Matt Ogden, Building Industry Partners. Founded my firm in 2008 to invest in the building products industry exclusively. So invest in distributors, manufacturers within building products that wanted capital to grow. We also back proven operators who have worked for companies in the industry who are looking to go out and build a company of their own with equity capital. We have invested in 5 platform companies since 2008. We were an early investor in USLBM, an early investor in Kodiak, and we have a kitchen cabinet manufacturing platform called United Cabinet Holdings with 2 cabinet plants. We have a Pacific Northwest regional lumberyard business called Home and Holdings, and we have a new fencing distribution installation platform based out of Denver, and now 10 locations in Colorado and Texas called US Fence. Yeah. So.
Great. Okay. Thank you, John.
I'm John Seagreen. I'm with Central Network Retail Group. Some you may know it as Synergy or CNRG, out of Memphis, Tennessee. My role there is to look over the operations, but in that role I get involved in a lot of the mergers and acquisitions that we've done. We're a multi-format, multi-brand company, so meaning that we don't just operate lumberyards. We have about, in rough terms, probably 20% of our store count or sales volume would be pro dealer, like many of you in the room, mostly lumber, building materials. But we also have another 20% that's probably just hardware. Hardware stores only, no lumber at all. And then everything else, the other 60% or so in the middle is home center, kind of a traditional home center, often in rural markets, serving both sides of the business. We've grown primarily by acquisition. We're a relatively young company, only about 6 years old as far as the actual entity, but in terms of the businesses and the people inside the company, of course, have been around a long time, and mostly grown by acquisition. We've done 16 acquisitions in the time we've been, the 5 or 6 years we've been around. We've also opened 9 new stores in that time period. We just opened our 83rd store Wednesday of this week in the Portland, Oregon market. So been very busy, and I think that's pretty much it.
Thank you. Thanks for being with us. Steve?
Morning. My name's Steve Swinney, founder and CEO of Kodiak Building Partners, based out of Denver, Colorado. Very similar background to John's business. We've done 11 acquisitions, launched in 2011. 11 acquisitions, as well as several greenfield expansions over the last couple of years. We operate 34 locations around the country, but mostly here in Texas and in Colorado. And we operate in several segments like John as well, lumber yards, drywall distribution, kitchen and bath showrooms, as well as construction supplies businesses.
Great, thank you. And LT?
Good morning. I'm LT Gibson, the CEO of USLBM. We founded USLBM in 2009, and I probably don't know exactly how many deals we've done. It's been around 40 or 50. But, even given that, we don't consider ourselves an acquirer. We consider ourselves, just maybe stewards of some of the best brands in the industry. We consider ourselves partners. We look to find, the perfect balance between being a national company and also a local company with local relationships. I mean, there's certainly advantages to both, and we try to find that line and huddle that line every day to make sure that we're bringing the most value to our businesses.
Great. Well, thank you. Thank you, all of you, and thank you for being willing to take part in the panel today. If you've participated in this session before, I hope you'll agree that the panel is always very forthcoming with impactful ideas that you can all use in your business, and so I'm glad to have you here to share those with you. Craig will be going around and asking for questions, and then the system is still in place with asking questions electronically. I think you're all getting very familiar with that, so feel free to ask questions that way as well. And so the title of the panel, if you noticed, is Sixth Inning Strategies. And the reason for that is that we had reached out to an industry participant who has literally 5 decades of experience in the industry, so you place a lot of weight on his opinion, and just said, hey, where do you think we're at in the cycle? How close are we to the next possibly soft patch? So, it feels like it's in about the sixth inning. And that really, even as a not a very big sports fan, that really resonated with me. First of all, I was glad he didn't say we're in the bottom of the ninth, 2 outs, 2 strikes. That wouldn't have been good. And sixth inning, it'd be nicer to think the second inning, but, let's be realistic. The recovery's been ongoing for a while. And so the thought was, we're in about the sixth inning, and we wanted to bring up a good panel of M&A acquirers and ask them, how do you react to being at this stage in the market, and what does it mean for you in terms of your M&A activities? And for all of you folks out there that might be considering buying another company, how should maybe you take this to be as far as a time to be undertaking M&A? So I'll start with the question that I guess has the risk of turning my panel against me from the outset, but do you agree with that assessment? Are we in the sixth inning, or do you feel that we're further along or not as far along toward what might be the next soft patch? And am I being overly optimistic to say soft patch, or do we have a sharp correction a few years from now? So we'll start at the end and work our way across. LT, if you want to comment on that.
Yeah, I think for the recovery, we're probably about the sixth inning in most markets. Some, like Chicago, we're probably in the third or fourth still. Others are in the seventh or eighth. But I think from acquisitions, it's really hard to put an inning, on it, because again, it matters. It depends on the company, on what your company does, where you're at in your personal life. So I think from acquisitions, there's always a buyer. If you've got a great business and you do the right things as a business, I don't think it matters what inning it is. Somebody much smarter than me could probably go back to 2010 and plot out if you sold in each year. If we're doing our job right up here, you should have got about the same amount of money in 2010 that you would get today at the end of the day. It's because what makes your business valuable really hasn't changed unless you've changed something structurally or strategically in your business.
Yeah, I would agree with that. I think what I would add to the conversation a little bit is, and you keep in the innings analogy as well, I think we're probably in the sixth inning of the recovery. I think our perspective is that this very well may be an extra innings game. We may have a correction along the way, but not like we've obviously seen 10 years ago. And so I think what that means for us as investors and operators within Kodiak is just a really exciting outlook for many years to come.
Great.
Yeah, I'm probably a little bit more optimistic. I don't know if it's the sixth or the fifth or whatever, but I think there's still room to go. I mean, if you look at historical cycles for real estate and housing, they tend to be 15, 16, 18-year, kind of what you see out there, and not that that's any guarantee for anything that's going to happen in the future, but I feel like maybe with a little bit more pro-business environment coming up, small business could benefit from some of the potential regulatory changes that at least are being talked about. I would like to think that there's a little more room left than that.
Great. Yeah.
All right, given this has been a very metric-oriented conference, which is wonderful, and baseball's a game of statistics. I did a little bit of math here just to try to bring some fill the interest in statistics here. So, all right, so making a couple assumptions here. If recovery is time from the cyclical low or the trough to let's call it equilibrium. Okay, so not time from the low to the next high, but time from low to equilibrium, which is a debatable term and it's subjective. But if we make that assumption, and we make the assumption that equilibrium has something to do with historic average housing start levels, and that's debatable too. There are good arguments for why equilibrium this time will, or equilibrium in the future will be a bit higher than equilibrium's been in the past. But if you make those two assumptions, recovery equals trough to equilibrium, equilibrium equals historic average levels. On the single-family side, we are now in 2016, we're at 68%. Single-family starts are at 68% of the historic long-term average start levels. Okay, if you apply that to 9 innings, we're in the top of the 7th with no outs. Okay.
I appreciate the mathematical rigor.
So here,
What's the count?
Yeah, you're right. So on the multifamily start side, okay, we're at 92% of the long-term historic average. So we're in the top of the 9th with 1 out. Okay, on the multifamily side. total starts, single-family and multifamily, we're at 78% in 2016 of the long-term historic average. So we just started the 8th inning, no outs, okay? The question is, to what Steve alluded to, this could be a really, really long game. It's been a really long game, right? And so just because we're in the top of the 7th or the 6th or the 8th doesn't mean that this has a long way to go, okay? So how long has this game been, all right? So if you look back at past cycles, on average, cyclical trough to historic average levels, it's taken on average 2.75 years to get from the trough to the average for total starts. Single family starts, it's taken 3.25 years to get from the trough to the average. This current cycle, it's now taken 5 years to get to where we are from the trough in single family. It's taken 7 years in total starts to get from the trough to where we are. So in baseball terms, if the average game is 3 hours, on the single family side, this game's been going on 4.5 hours, and we're in the top of the 7th. For total starts, this game's been going on 7.5 hours, and we're in the top of the 8th. So it's been a really long game, and it may be a very long game. It very well may go to extra innings. The good thing is that there's still, we're still on the right side of the curve. There's still time to go from starts where we are now to historic equilibrium. And by the way, as soon as we get to equilibrium, that doesn't mean the next down cycle's coming. There's typically time from equilibrium to the peak. So it's been a long game. It's gonna be a much longer game.
Remind me not to join your fantasy league.
I didn't want to break the string of metric-oriented.
I appreciate it. I did point that out as being the place where I could lose my panel at my first question, but I appreciate that. No, that's excellent. I guess, is there a question from the electronic?
Yes, sorry. Yes, there is.
Great.
I have two, actually, but the first question is, what are typical purchase price multiples in the industry right now?
Okay, well, I knew that question would come up. I didn't think it would be so soon into the.
It was the first one.
Into the presentations. Yes, I guess that's the audience's way of saying cut to the chase. I was not planning to pose that particular question because I find that to be a tough question to answer in a vacuum. So I guess I'll give you an out. If anybody on the panel wants to take that on with a number coming in their answer, then you're welcome to do so. Otherwise, I guess if you could comment on sort of which direction you see multiples headed, answer that question in whatever way you're comfortable. That's a tough question. So I'll
I think regardless of where you think we are in the cycle, what inning, as you get closer to, equilibrium, multiples go down. You could obviously in 2010 pay a much higher multiple if it was a good business. Like I said, there's a value inherent in each of these businesses based on the teams you have, the way you run them, the market share you have, and that's true in any market conditions. But as you get closer to a whole market, the multiples are obviously down. Doesn't mean you get less money, just mean, it's just a way to value the business. You can look at it from the multiple on assets, you can look at it multiple on earnings. A lot of ways to look at your business and value your business. But at the end of the day, it's worth, what somebody's willing to pay. And the more things that you do well, obviously the more you're going to get for your business. So I don't really worry as much about multiples as I do the teams and the partners and how we're going to acquire and the synergy we're going to get. So I have to sit down with each one of you, which we could do, and then tell you what your business would be worth to us. But that would obviously, take some sharing of information and, there's synergy inherent in each deal, and that makes businesses more valuable, makes ours more valuable and yours. So that's a conversation you have to have.
Yeah, no, I agree.
Yeah, I think it varies so much. I mean, what geography are you in and where are we in that local market in the recovery is a factor, certainly. What segment you're in, I know most of this audience is LBM, but again, we look at several different segments and it varies, can vary widely. So I think there's just so many factors. I think, how well and efficient your business is running, the team, and, to your point, LT, what the path is for that team, and who we're going to be partnering with is a huge factor for us. So I think there's just so many factors. It's hard to really pin down a number. I will say, I think we've seen multiples come down over the last few years. Mm-hmm. But again, as LT said, I think that's a function more of the growth and recovery of your businesses than it is overall valuation.
Right. Okay.
Yeah, I would second that. We do pro forma analysis of every company we look at, and they're different. I mean, it depends on whether you're talking about some businesses are very profitable and others are more of a turnaround situation, and you evaluate those differently, and you look at assets more than a multiple of earnings. So
Sure.
it's going to depend.
You got any baseball?
I don't want to be the quantitative guy up here.
If a multiple were the innings,
I don't want to be
what inning are we in?
the quantitative guy here. But I would just say this. I'd say this is a cyclical industry, right? And in cyclical industries, as a buyer, you've got to look at businesses with a perspective of peak to trough, right? You got to look at the business as if you're going to own it through the duration of an entire cycle. And so right now, times are pretty good. They're going to get better. Times always get too good, and then they get too bad. But they always, in a cyclical industry, things always revert to a mean. And as we evaluate businesses, I think we're looking to try to estimate sort of what the performance is going to be of a business sort of in a normal market, sort of in equilibrium. And then we've got to be prudent with respect to that. As LT alluded to, as the cycle advances, okay, valuations should come down rationally, okay, because you invest early in the cycle, you got a lot of upside. You got longer amount of time until the next downturn. As the cycle improves, you've got less upside, historically speaking, and you've got a shorter window until the next downturn. So as a buyer, you should be more conservative. Rationally speaking, I think you should pay less. You pay less money. Like LT also said, your company is worth what a buyer's willing to pay for it. There are rational buyers. There are irrational buyers. Hopefully, you meet an irrational buyer when you're selling. But it's I never invest in companies or look to build companies with that hope in mind. I'll give you one data point. Lenoga, sold to Strober at the time to form ProBuild at about 6 times. So to me, as an investor, that's the cap. That's the cap in a sort of in a rational environment. And that was a $2 billion sales business. And so I may be in the minority, but I look at lumberyards and I look at the margins, I look at the cyclicality, I look at the historic multiples. To me, businesses under 25 million sales, 3 to 4 times I think is a reasonable multiple of EBITDA. Businesses over 25 million sales, maybe 4 to 5 times. I mean, to me, those are rational multiples. Will you find people that will pay more, and you can find somebody to pay anything, with any product. But those are kind of rational level multiples that I would maybe provide as guidance.
Okay, great, thank you. That's all. I expected that question. Like I said, it came quicker than I expected. If you look at the statistics of the transactions that have been done, there's a lot of active buying on the part of specialty dealers, and there are a lot of specialty dealers being acquired. So that would indicate a trend toward a focus on specialty dealers. But on the flip side, you've got previously very specialized company like ABC buying L&W Supply and getting into drywall, and unexpected, nobody saw that coming, or at least few people saw that coming. In the balance, 5 years from now, what do you think the industry looks like? Are we all broad lines because the specialty have added lines, or are we more specialty? What do you see the trend in that regard, specialty versus broad lines?
Yeah, I think we maybe look at the business a little bit differently. I mean, we look at it by segment. We think of ourselves as a specialty dealer, even though many people think we're a pro dealer, a lumberyard owner. We view lumber as a specialty product category. There's special skills, special handling, special equipment. We view roofing the same way. We view wallboard the same way. And we specialize in each of those businesses, and we bring core competencies. We've done a lot of our acquisitions to gain the knowledge that we needed. I think yesterday when you saw some of the charts about, what limits your business, what limited our business in a lot of these things, where we didn't know how to buy the products, we didn't know how to sell it, we didn't know how that, the direct relationships worked. So we've gone out and acquired that. So we, one of the things that we bring to the businesses that we partner with, if they're full-line pro dealers, is we bring the ability to sell all these specialty product categories that they maybe have lost over time because they don't have a critical mass. We by our size we now can be a specialty dealer in all of those categories, whether it's fasteners, windows, wallboard, cabinets, whatever it might be. So that's really our focus. We're a specialty dealer broken up into 6 or 7 different parts, and I think we see that really is the future. Is our people want to deal with less people, they want to deal electronically, they want to deal differently. We're trying to build the company that can handle that.
Yeah, Michael, when we started out in 2011, this diversity was really a core kind of central strategy to what Kodiak wanted to do. Was not just be in one segment, excuse me, in LBM, but be in several segments of the building space. And so, we looked at that, reasons being, as Matt kind of alluded to some of the stats of different parts of the construction community, that we wanted to serve not just single family, but multi, commercial, and infrastructure. And so really, you do that by being in different segments. So that's really been a tenet of what we've tried to do and kind of our vision for the long term at Kodiak. We frankly think it's a great approach to have over the long run because while we are in a cyclical industry, none of those different building cycles are perfectly correlated. I think the second thing I'd say that why we think that's kind of where things are going is that at the core, all of these businesses we find to be incredibly similar in those core drivers of what makes you successful as a distributor. Certainly the metrics may look different, as LT was saying, the investment in CapEx looks different, your fleet looks different, but at the end of the day, what makes, in our opinion, a drywall distributor or a construction supplies business or a lumber yard or any other segment really successful has much, much more to do with all the things we were hearing about yesterday in terms of the culture and the engagement of your team, the way you serve and take care of your customers, the integrity you do that with. Those are the things, in our opinion, that really make all of these businesses successful. And so when you're like us and you're very decentralized, very locally driven, very entrepreneurial in your business, our role in the corporate team is just to serve those guys out in the field, take care of them, support them, give them what they need so that they can go out and take care of their customer in the marketplace.
Okay, thank you.
In most of the markets that we're in, where we sell lumber building materials, like as I mentioned earlier, they tend to be more rural, and I don't think we felt the pressure of the specialty distribution quite as acutely as some of the folks that are in the more metro markets. But certainly there is an impact, and I've certainly noticed it on the from the standpoint of the equipment, the ante, so to speak, the things that are out there that more and more customers are knowing about and wanting. But I think there's kind of a natural pendulum between specialty and broadline that that tends to move back and forth, and for a lot of our customers in those markets where we're selling LBM materials, the customer is still very interested in buying from one place, having one salesperson, and I know that model, for now at least, appears a little bit outdated in terms of the whole picture of the industry, but I think there's still a way to do that if you can do some of the things that Steve mentions in terms of having those basic disciplines in place with respect to the discipline to do it right, the metrics to measure it. I think you can do both.
Great. Yeah.
I guess my view would be in almost anything in business, anything in life, I think specialist beats generalist. A little bit biased, within my industry, within the private equity investment world. That was my take on the world. I chose to specialize in an industry, feeling like if I focus my time, my energy in one segment, as opposed to investing in building products today, technology tomorrow, auto parts another day, et cetera, that there's no way a generalist could compete with my effort in the segment I chose to focus in. We only have so many hours in the day. If I focus all my time, all my energy in one segment of the world, I just feel like that's a huge competitive advantage. I see the same thing in building products over the long run. Over the long run, specialist beats generalist. there's just no way that an organization that's broadly diversified in terms of focus, expertise, et cetera, can give the same quality of thought, quality of effort as a specialist can in any given category. The good news, though, I think, is that the markets are only big enough for specialists in certain markets. So in large metro areas, I think, in large markets that can support that can support specialists, where the market is large enough to support a specialty drywall distributor, I think there'll be a continued trend towards specialists. In the smaller markets, like CNRG is in, and USLBM is in a lot of those markets, and Kodiak as well, the market's just not big enough to have specialists in all these different categories. So the generalist lumberyard will continue to thrive and for the long run. So I think the market, the size of the market dictates where specialists can be successful, but all else being equal, specialists be generalists.
Great. Okay. Thank you, guys.
If I could follow up just
Sure,
real quick
please.
on that. The one part of that I would challenge is, picture you're in Dallas, Texas, and there are 4 specialty dealers, one in cabinets, one in wallboard, one in fasteners, one in interior doors, and then picture the same person owning all 4 of those businesses. You would consider that person a broadline distributor, but they look, act, and feel like a specialist. That's what I would challenge each of you. No matter how big your business is, you can focus on each segment like a specialist. You can have different people in your organization in charge of each one of those categories where they focus, live, die, eat. That's how they, make their living on that category. So, while you might look like a broadline distributor, you can still be very focused on each of these specialty segments.
And just so LT, I would agree, and I think that's the brilliance. I'm a little biased, but I think that's the brilliance of USLBM and Kodiak, which is, they have built portfolios of specialists or generalists where the market makes sense to have a generalist. But I think they understand the importance of leadership focused on niches, on segments, and they've structured their organizations to have talented operators solely focused on businesses that in a lot of cases are specialists. So they're, in a lot of ways, portfolios of specialists, and that I agree completely.
Great. Thank you. I think we had a question from the audience.
Yes. Assuming capital gains and corporate tax rates get reduced this year, how do you think that will impact M&A activity?
Okay. And that was going to be one of our questions, was sort of, are there any tax policies that you've got an eye? So if you
anytime there's obviously more money, there's, it's easier to invest that money. People want to invest it, but everything moves together, whether it's tax cuts, whether it's immigration policy, whether it's, repeal, the Affordable Care Act. All of those things affect us all equally, so we're all in the same boat. So I really don't view any of those things as monumental changes because it affects all of us. But, obviously more money, more to invest in the industry is a good thing for everybody, and a good thing for homeowners too, because they can invest in houses.
I'd agree. It obviously creates a little additional free cash flow. It creates more motivation for you guys as potential sellers because the tax rates you're going to have are lower. I think kind of broadening the question to other tax policies or governmental policies, I think certainly, certainly the mortgage interest deduction, that's something that we think about a lot in terms of if they were to try to monkey with that. I think that would be another factor that would really extend the ball game, going back to the earlier analogy.
Okay.
Yeah, certainly second that. I would also add that in terms of some of the individual tax proposals that are being talked about, no one knows for sure what we're going to see from the new administration, but the any pass-through entity, S-corp type, it's unclear from what I've read, at least, as far as how those entities would be potentially impacted by any proposed new legislation on taxes, and I think that could have an impact in terms of how some sellers might view their options going forward.
Okay. Yeah.
Nothing to add there. The expectations of tax changes are not affecting our M&A activity at all.
So it's not something you're you're taking into account. Okay. Well, when you take a look at the bond markets, the markets have clearly priced in a couple of interest rate hikes during the course of this year. How does that impact your view of the world? Is that important to you? Obviously, on one side, if you're borrowing money to make acquisitions, the cost of capital just went up. The other side of it is out in the residential housing market, the cost of mortgages just went up. So it would be impossible to stand up here and say an interest rate hike will somehow help mortgage activity. That's not going to happen. It can only hurt it. But is it concerning to you that the market has this hike priced in, and do you think that hike will have an impact either as buyers or on the residential side, if you can all
I mean, I think the first thing that happens when rate hikes, occur are people that have been on the fence maybe get motivated to buy. So I think it actually, in the short term, can help our businesses. If it goes up faster than we think or stays up, maybe, you got to think about it in historically where we're at now. I mean, money is still unbelievably cheap. In a macro context, I mean, it would have to go up a lot before I think people decide not to buy a house. You see a lot of people, they buy, they always find a way to get the things they want. And if it's the time in their life where they're married, they have kids, they want a house, they're probably still going to buy a house. They're not going to let a quarter point or half point or even a full point of interest rates change that.
Yeah, I mean, to me, the rates across the board, whether it's mortgage or our cost of borrowing, your cost of borrowing, they're so low from historical standards. I think we've got a long way to go before that really starts to meaningfully impact the way we do business and the way we invest in our businesses and the way homeowners think about their purchasing decisions.
Yeah, I agree. I think that interest rates going a little higher is a good thing. I mean, really, we've been artificially low for a long time, and the signal that if the Fed's going to take rates up a couple of times in 2017, the economy's getting stronger. I think we're seeing that in the stock market, and in general, a healthier economy, I think, is good for our businesses that exist, and it's good for anybody that's looking to sell their business and have a good year when they do so. So I'm not at all frightened of the slightly higher rates, and like LT said, if it got to the point where it was out of the range, it could be a different story. But some sort of modest increase in rates would probably be a good thing for the overall economy.
Yeah, I'd say I'm not worried about rate increases. Lots of houses have been built and bought throughout history at much higher interest rate levels than we're even close to approaching. To me, the fundamental need for housing, the fundamental undersupply that we have, I don't believe will be derailed by rising interest rates over time. Will the trajectory of the recovery be slowed? Yeah, I think so. I think that's a good thing, though. I mean, we're in good times. We want this party to last. I think the longer this game goes, the better for all of us in the room. It gives us opportunity to, improve our performance, use cash flow to de-lever, gives us opportunities to make more investments and buy more businesses while we're on this side of equilibrium. I don't know much about anything, but I do feel like interest rates will probably increase this year, and I think it's just fine for our industry. The one thing I would say is I do think anticipating that interest rates will not always be this low is just another reminder that during these good times, while things are getting better, you want to be paying down your debt, you want to be delevering. Everybody in this room survived the worst recession since the Great Depression, and I would bet that it was largely one of the key drivers of your survival was that you didn't have a lot of debt at the time the crash happened, or obviously you were able to deal with the debt level you had. Just be aware that we're at all-time low interest rates. Interest rates may rise. The debt you do have will get more expensive. Just a little further incentive to be delevering as we approach equilibrium. You certainly don't want to have a lot of debt in advance of, as we approach the next downturn, and equilibrium leads to the next downturn. So, another reminder to delever.
Well, and if nothing else, if we're at 0% interest rates, the Fed loses that ability to cut rates the next time there is a soft patch to stimulate the economy. You've got to be at a positive interest rate environment in order to be able to use that lever. Marisa, did you have another audience question?
Yes. We've just had several questions come through about the audience or some of the dealers wanting to sell their company and wondering what they should be doing to prepare for selling. Should they be hiring an M&A advisor? Should they get a bank advisor? What do they need to be doing to prepare their companies for transition?
Is my sister in the audience somewhere? We have a family member. I feel like I should recuse myself from answering that question. So I guess I'll throw that over to the panel if you want to.
I'll take off my acquire hat and then just tell you as a business owner, a business person, I think the first thing you should do is talk to an advisor, somebody in the industry like a Gian or somebody else that knows the industry, knows how to prepare your BIP, Building Industry Associates. I think it not only helps you understand what's important for a potential acquirer, but it tells you what's important to get ready for, so you don't spend a lot of time doing things that you don't need to do. There are things about your business that aren't perfect, and we're okay with that because that's part of our synergy model. It helps us realize that we're going to be able to add value to your business. One of the reasons we want to partner with you, there are really two reasons. One, we can make you better with some of the things we do, and the other is you can make us better with some of the things you do. Those things don't change, but how you want to get ready personally, how your tax situations, those things are all probably a good thing to talk to somebody like that about a year in advance, and they can really help you. I think they do pay for themselves, and I'll deny that after this panel. I'm sure it's being recorded. So, but I do think they add value and can add peace of mind because you understand what's market, how the deals work, what to expect, what not to expect. When we do a deal without somebody involved on their side representing them, they have a lot of surprises about how things work or how they don't work, and it's just probably give you a lot more peace of mind if you have somebody on your side that's familiar with the process.
Yeah, I just say, just get a piece of paper out and write this down. Just call Kodiak at 303.
Steve has chosen not to recuse himself from that question.
No, I think, not to play to our moderator here, but I do think.
Go ahead.
I think, having an advisor is a really good step. You wouldn't, we were talking earlier about having specialists in your business that focus on cabinets or focus on drywall, whatever the product category is, and having an expert. These guys are experts in what they do, and if you're going to be exploring a transaction for the company that your family's built, you've run for 30, 40, 50, 80 years, whatever the number may be, that's an incredibly special and critical and important move you're going to make, and you want someone who is an expert at that kind of transaction, just like you're an expert in your business. So that's the first thing I'd say. Mm-hmm. And then the second thing I'd say is there's just no substitute ever, in my mind, for not running your business really well, being the best operator you can be, building your team, engaging your employees. I think I can probably speak for all these guys in saying, and I think this maybe is another question later, Michael, but the biggest roadblock that breaks down a deal, gets us to a no on a transaction is culture. And when we walk in and are getting to know a company and we see a place that doesn't operate, and we don't see this very often, but doesn't operate with integrity, doesn't take care of their customer, doesn't take care of their employees, doesn't care what happens to them after the transaction, that's when the conversation ends really quickly for us, because that just would never fit with our business. So I think the best thing you can do if you're going to sell, whether it's next week or next year or 20 years down the road, is you build a great business, and that's what you've been doing.
Right. Yep.
Yeah, I mean, certainly advisors add value, depending on who you talk to and what type of deal it is. But I think that we went into a lot of sellers, a lot of people, prospective companies that are looking to talk to us, that their biggest worry or concern is how will my, the legacy that I've created, how will that be translated into the future under some other ownership or some other guidance. And, we work hard at being good stewards of that brand. We don't operate any brands under the name Central Network Retail Group. They're always the brand that the company had over time and that ownership established. And we work very hard to try to reassure sellers of that. So I think there's Steve kind of spoke of the emotional aspect that a seller goes through, and I can relate to that. I mean, I was part of a family business that sold as well, and it is a very emotional, gut-wrenching type of thing that you step through, and when you think of how the future ownership is going to take care of your company, I mean, you need to talk about preparing for a sale. It's more than just putting together the book with the charts in it. You have to really prepare yourself first as ownership, and then prepare your team to be able to, continue on that responsibility of running the business, but under different ownership and perhaps slightly different, criteria.
I'd say in terms of preparing your business for a possible exit in the years ahead, I don't think there's anything you could do that would be more valuable than building your management team. One of the biggest roadblocks for us and have an interest in a business, or one of the biggest reasons we would devalue a business, would be that we felt with an owner that's selling, that's taken out all of their money out of the business, or most of their money out of the business, that they are largely we're responsible, and largely are responsible for the go-forward value of that business, and they're pulling back while we're coming into the business. And so, if the customer relationships, if the business know-how, if the supplier relationships, if the brand is largely associated with or concentrated with one person or a couple people, that's going to be a lot more challenging to get excited about as a buyer, or to value more highly as a buyer, than if you've got a robust management team. And that's subjective term, how many people that is and what they do. But ideally, you want to feel like the person who's taking their money out of the business, that the success of the business going forward is not largely tied to the person who's taking most of their money out of the business. I'd say that's a key concept that I think all of us evaluate when looking at a business. Yeah, and just to answer the second question in terms of an advisor, look, I mean, you wouldn't negotiate legal docs without a lawyer. You wouldn't do complex tax work without an accountant. In my view, you really shouldn't be negotiating a complex sale of your business without an advisor. Lawyers don't have the specialized knowledge to help structure a deal, nor do they know what's market in sale transactions. Accountants don't have the specialized knowledge that it requires to structure these complex sale transactions. M&A advisors, investment banks, transaction advisors do. So I would echo these guys in advising you to have an advisor. I think the quality of advisors out there differs tremendously. You have what I'd call unsophisticated business brokers, who are guys who are just signing up businesses to sell. Their probability of success in selling your business is rather low, but they sign up a lot of businesses, and they hit some, they don't hit others, and that's certainly not what you want. They don't have specialized knowledge, and they don't have sophisticated knowledge in structuring transactions. They don't have knowledge about the building industry. They don't have knowledge about market valuations. So you certainly don't want to go with one of those. Which I think you want a sophisticated transaction advisor, and my personal biased opinion is, ideally one that's focused in your industry. And I would say this, just because you hire an advisor doesn't mean you need to run a large formal process. I know a lot of people are reluctant to go run a large formal process. I certainly would be if I was selling a business. I don't want that disruption to my business, because the process can be disruptive. I may want to talk to one buyer or two buyers, but still you can hire a sophisticated advisor, the right advisor, to advise you in speaking with one or two buyers. So hire an advisor doesn't mean you've got to run a robust extensive process. So.
And all of your responses hit on a question I wanted to ask. And Maurice, I know you have one. I want to just expand that question in one way. It's very common for us at the beginning of working with a client for there to be a lot of fear and anxiety on the part of the client about the notion of taking the message out to the market that a company is for sale and the way that it's handled and so forth. There's a lot of fear and nervousness. Can you just comment on what you find to be typical? Have you ever heard of a company harmed by a sale process? How does it go? I know how we keep the, confidentiality and things like that on our end, but from the buyer's perspective, what would you say to a business owner that might be fearful of the notion of having their company taken out to market? What comfort can you give them that based on what you've seen, each of you?
I mean, the first thing I'll say is, we're all pretty aware of what goes on in the industry, but I'll tell you, we probably talk to a potential seller maybe 3 a week. Jim's out here somewhere. But, so think about that. You don't hear about 150 people thinking about selling their business. So a lot of people can have those conversations, can kick tires, can show some interest without, the world knowing about it. I know, again, I think about, the bankers we deal with the most, they're, very reputable, the same with us. I mean, it just doesn't get out like it used to. I think vendors used to be the main way that things kind of traveled from business to business. So I think it's really up to you guys who you tell and who's involved, whether or not, there's any problems. But I understand the fear. The fear is just uncertainty. If your people here, you might be selling the business, they think things are going to change. There's a right buyer for each of you. If you go find the right buyer, it only helps your business. It brings resources to your business. If you just sell, get the most money you can, you sell to somebody that's going to change everything, and then you get out of the way, that's going to be disruptive for them and your business, and that's certainly a choice you could make. But most people in our industry, most people that have inherited these brands and created these companies, they have more of a feeling of responsibility. So I think finding the right buyer, and that's again where I think a good banker can help you, a good broker can help you understand who the different buyers are, their track record with companies like yours, what they do, what they don't, how that affects the people, and what the future looks like for you and your people.
Yeah, I mean, I think if you acquire regularly, like all of us do up here, if you don't do that with a lot of respect and integrity for the folks you're dealing with, you're not going to be in the acquisition game very long. So I think I can speak for everyone up here when I say, we treat that kind of a delicate, confidential dialogue with an extreme amount of respect. I think the biggest thing you've got to be careful of in that process is, as LT said, kind of who you talk to on your side of things. And I would caution you to be very, very careful about that, because it is, as we've been talking about, it's a huge decision. Your people, if you go into that kind of a process and a dialogue, are going to have all kinds of questions, all kinds of concerns, and they're good and valid and reasonable concerns. They want to know that certainty of what's going to go on in the future. And when you're going through the process, when you're talking to different folks and exploring what's going to happen, you don't have the answers for them yet. And I think it's incumbent upon you to really be responsible with holding that close until you can come to your team with all the right answers and let them know what's going on. So I think it's a very, very important thing to be cautious of. But I think, again, having the right advisor, talking to responsible buyers are the steps that's going to insulate you from anything external, and then it's really just up to you and how you manage the process on your end.
Mm-hmm. Well, one factor that I've seen make a difference is, different companies are more communicative with their own situations, long before the acquisition, in terms of their own people. Succession planning is something that people know that there has to be a plan for a company as it ages, and some owners are much more open about that in terms of with their key management team than others. When they are open, to me, it tends to make the process easier, because when everything's held very closely and not discussed, then any deviation where there's an open discussion going on is going to create some anxiety on the part of the employee base in particular. But where the ownership's been very open about, hey, we're going to be developing plans in the future and trying to be answer those questions openly, even if there's not a specific buyer, specific date, specific plan. The team feels a little more at ease with the idea that somebody's looking out for the business. And then when there actually does begin discussions, it seems to me that when there's a high level of trust and confidentiality among the management team at the business, to where you can have 3 or 4 or 5 people in the loop that can help you through the diligence process, it's much easier than if it's just one person and you're trying to have to kind of sneak around make up, I'm a banker, or I'm an insurance guy, or I'm from OSHA, or whatever. That makes it a lot harder. So
I've pretended to be a lot of different things over the years, fire inspector or insurance person. To your point on the openness, we've encountered private equity funds, no one on this stage, that will say, they're telling the employees they bought the company, and by the way, we'll probably sell this company 5 years from now. Just sort of rip the Band-Aid off right away and let them know this is an investment and we're going to grow this company and make it better. And it's kind of a sigh of relief. It's talked about all the time, and then there's never some big moment. So that's definitely a strategy.
I would just add that obviously, confidentiality is a critical issue. You want to deliver the message to your people when you want to and how you want to. But just to put you at a little bit of ease, I've never seen a confidentiality breach in a transaction that I've been involved with, whether at prior firms I worked for under my own banner. Earlier in my career as an investment banker, I worked with multiple buyers. I've never seen a confidentiality breach materially impact a seller.
By a quick show of hands, anybody ever even encounter a company hurt by a sale process?
Well, that's a different question.
No, but I mean, not after the sale, by the process, meaning, in other words, by the act of selling the company, they were hurt by it. Have you encountered that?
Not
Never
due to
mind.
confidentiality?
Go ahead. Have you encountered that?
Absolutely.
Have you?
Not due to confidentiality. I mean, a sale process, if it's extended, if it's a large process involving 10 buyers coming through a business, is very time-consuming and distracting for a management team. So if you decide to sell your business, I would encourage you to, I would probably encourage a smaller process, a more compressed process, because the reality is they can be very time-consuming in providing information, answering questions, et cetera, to buyers, particularly if there's multiple buyers. The investment bank, your advisor, helps with that to some degree, but there's no question that business performance suffers to some degree while you're in the midst of a sale process, all else being equal.
Yeah, I'd agree with that. It's a distraction, but I think that's one of the areas where an advisor can help is instead of making it 10 companies, they help with that matchmaking process early on before you really get into the items that can be super distracting.
Yeah. As a general rule, I've not come across companies that were hurt by it per se, where the process of going out to market hurt them. Marisa, do you have a question? I have one ready, unless you do.
Yeah, I do. When you're buying a traditional lumberyard that is family-owned, what's the most common denominator you find that needs to be fixed or can be improved right away?
Great question. LT, you want to start with that?
Again, I don't like the word traditional lumberyard because I think those are lumber specialty dealers. I think that, the opportunities we see are, the local relationships are fantastic. A lot of times it's maybe on the purchasing side where we may, be able to, get better terms or maybe better pricing on items, better rebates. I mean, that's part of it. I think adding products is a big advantage to maybe a traditional, what you might think of as a traditional lumberyard. Over time, they might have given up wallboard, cabinets, sheetrock, I said sheetrock twice there, but some of those specialty products they might have given up over time that we could add back to that business because of the customer relationships you have. So I think businesses that made it through the downturn that are here today, you don't see these these really large issues inside the business. What you see are opportunities to grow that business and to work together to partner. And that's really what we're looking for with those partners, is the team, the aggressiveness, the want to improve, and the things that you have that are very special to you that we could take. Maybe your truck turnaround is one of the best in the industry, or those best practices you have that we can share across our platform. And we use people like, Randy that you met yesterday to kind of share that information across the group.
I mean, I think the most common denominator of opportunity in a deal and in a transaction is typically working capital. I think that the better you manage your AR and your inventory turns, in particular, the more you're going to maximize the cash value of your business for yourself. If one of us comes in and is looking at a valuation for your company, and you typically operate on 90-day AR days, that's what we're going to expect to continue. We're going to want to work on that, but that's what we're going to buy off of. If you operate at 40 days, that's what we're going to buy off of. And the delta there is cash in your bank account. So I think that's typically the biggest area of opportunity. And I think some of it is because, you may have been in the market for 50 years, and you may allow a guy to go out 75, 80 days, and you feel like, hey, he's always going to pay us. We've got a great relationship. I don't have to worry about collecting that. And you're probably right. But in the meantime, he's holding your cash and not you, and I don't think he's going to give it back to you at the at the sale. So I would really encourage you to work on working capital and manage that really well. I think that's a big area of opportunity we typically see in the business.
Yeah, certainly agree with purchasing and working capital. We also run into a lot of the businesses we're talking to are smaller, and they're typically out of compliance in a lot of areas, that whether it be safety or HR compliance, maybe they're running antiquated systems, things like that, and those are areas where we see opportunity. They're typically paying too much for things like insurance, payroll processing. And so, those are easy improvements because they're not involving the customer at all. The customer's getting the same experience when they come to the store, but their cost savings are real, and oftentimes it can not only save money but actually help bring the business back into a less risky environment with respect to regulation.
Mm-hmm.
I might just reemphasize Steve's point. I'd say in 2/3 of the time, when we look at a business, that business has not focused on the working capital component of their business like they can. And if you think about return on assets, okay, return on assets is oversimplifying here, but EBITDA less your investment in working capital less CapEx. There's a lot of focus on EBITDA, pre-tax earnings. There's, I think, plenty focus on minimizing CapEx. There's not a lot of focus on minimizing working capital in the business, and understanding that if you can reduce your AR days outstanding, you can improve your inventory turns, and you can extend your AP terms. Not saying you pay your vendors late, but you negotiate longer terms. You can bring your working capital down, minimize your working capital investment in that equation, improve your return on assets. That cash is cash that goes into the bank or goes to pay down your debt. Very significant financial opportunity there for you, for us as buyers. I don't know as much, I don't know CNRG as intimately, but these guys are brilliant working capital management guys, and they have created tremendous equity value in their businesses through better managing working capital of businesses they've invested in. That's something you can do on your own as well.
We're brilliant too.
I figure.
Let's clear that up, right? Okay, so with the election behind us, one of the big issues of the day and the questions of the day is undocumented workers. And we're starting to have some conversations with potential buyers about steps they're taking to due diligence that issue. So we wanted to ask the panelists to comment on when you're looking at a company under the new Trump administration, how do you view the issue of undocumented workers? Are you taking any additional due diligence steps that you didn't take previously? And if you're willing to be this specific, if you care not to, that's fine too. If you could comment on whether or not I-9 checking the box that everybody has I-9s is sufficient, or are you an E-Verify, requirement now? We're seeing some pressure along that line, so I'd be curious to have all of you address that.
Right. I think, we always, include that as part of our due diligence, that, to look at that. We certainly don't want, we don't want issues. We understand, there are 11 million undocumented workers in the United States. There's a chance some of them work in our industry. But that said, we certainly don't encourage it. We don't make it easy. We want to do things the right way. We're, I would say, those of you know me, I'm very pro-immigration, but I think we want people to do it the right way. So we certainly look into it. We've never seen a big issue, with anyone that we've ever had. So but we haven't really changed anything under the Trump administration.
We haven't either. I mean, we do use E-Verify. We use that in every transaction.
And when you say use it, how do you mean that? You request the seller to use it?
No, so when we acquire a company, we're really, technically, we're rehiring all those employees on day one. And so that is part of our hiring process,
okay.
Whether it's in an acquisition or just in our day-to-day business every day. And like LT, I mean, I think we'd love to see a really big solution to immigration reform. It certainly would help our broad industry. It probably helps our customers more than it helps us if we can get that figured out in terms of resources out on the lots to build homes. But yeah, I mean, it hasn't changed anything. We've been doing that since 2011, so it's kind of business as usual for us.
Yeah, we're exactly the same. We terminate from the old company, rehire, use E-Verify to bring those folks on. I would say that the immigration policy is probably most likely to have an impact on the industry from a construction labor standpoint, and I could see that worsening an already tough situation.
Okay.
Same as these guys, we kind of insist on E-Verify. Certainly has heightened our anxiety over it for sure. Yeah, I mean, it's estimated that 15% of construction labor in the U.S. is comprised of undocumented workers. So to the extent we're, we are deporting more immigrants or making it harder for undocumented immigrants to come into the country, certainly it's going to have some effect on the labor shortage we've got.
Okay, yeah, interesting. So then another aspect of Donald Trump when he was running for president, he talked a lot about infrastructure improvements. It certainly is, remains a topic now. Was mentioned in the address to the joint session of Congress last week. Assuming that those big infrastructure improvements happen, number one, I guess, do you spend any time wondering about what that would look like and how to benefit from that? And is there any aspect of that you think, oh, well, if that happens, here's the ways that'll benefit our various businesses? Obviously, we don't build roads and bridges in this country, but you would expect there to be tangential benefits. Is that
Yeah, but I think those things typically improve the economy, and that's obviously good for all of us. I think the potential negative is there's a limited amount of labor right now. And sometimes, that'll move labor from the construction sites, to the road building and infrastructure building. So I think it could exacerbate an already existing problem. But, I think that's generally healthy for the country and healthy, for the economy.
So I'm probably a little bit unique up here in that our business does directly serve the infrastructure space. That's part of our diversified view of the industry. So we do probably about 10 to 15% of our sales are infrastructure related, roads and bridges. And
oh, okay. Sorry, pardon my not knowing.
Well, no, that's okay. That's the construction supply space that we're in, and so we do concrete accessories, rebar fabrication, things like that in that segment. And so certainly that's something we're pretty excited about. It's certainly a lift for our business. Although I'd agree with LT. I think overall it's just an economic boost. So I think it helps all of us. I think it helps all of our businesses. But for us, it is an area we participate in very directly.
Great.
We have pretty good retail share, as I said, as part of our sales volume, sales base. So anything that's going to promote job growth, wage growth is a really good thing for us. So
We are, we've always looked at infrastructure as a long-term need. I think everyone knows it's a long-term need. It's certainly heightened our interest in that segment. We're actively right now looking at businesses that provide guardrail and commercial structures in highways. So
Okay, great. Yeah, Maurice, I think you had a question.
how do you view real estate ownership and valuing a company? Do you want the companies you acquire to own real estate?
Right, great question. Yeah.
We own real estate ourselves, but we also can leave it behind and let the owner become the landlord, or we'll help negotiate a third-party purchase of that. It really just depends on on how you want the transaction structured, what's important to you, what's important to your family. There's a lot of different ways to work with that, but we're not set on any one way. We own some property, we've negotiated third party, and we've used ex-owners as landlords.
So we use ex-owners as landlords as well very frequently in our portfolio. We don't own any real estate, so like LT said, we've done the same thing. If we've got a seller that we're working to partner with that really wants to sell that real estate, we'll often help in that process and facilitating bringing them together with a new real estate investor that will then lease to us. But we have not really made it a practice of buying real estate.
We don't own any real estate. We lease everything, but much like LT and Steve mentioned, we're happy to try to find a third-party buyer if that's something that the seller's really interested in doing. But we like having the ex-owner as a landlord and think that kind of keeps them interested in the business. We'd like them to be interested in it for a lot of reasons, but that's one additional reason. And for them, it creates an annuity, at least for whatever the lease term is, that they could factor into their planning over time. And we actually try to, even if we're not buying the real estate, we try to illustrate all that to the seller when we talk about all the parameters of the deal.
Echo these guys. It's hard. It's hard enough for us to try to figure out what the right value of a business is. We certainly don't have as much expertise in trying to figure out what the value of real estate is. So don't view ourselves as real estate investors. View ourselves as business investors. And so we look to lease the real estate back to the owner, or use, as these guys said, there are institutions out there that will partner with buyers to while the buyer one of us buys the business, they'll buy the real estate and lease it back to the buyer of the business. Those are called real estate sale leaseback firms. And so we'll, I think, work with firms like that to accomplish solutions to sell business and real estate for owners that want to do that.
Michael, can I, over here, Craig, it's Craig, I'll way to your left.
Oh, I'm sorry.
That's okay, I'm hiding on this side. Can I ask a follow-up question related to this?
Of course.
One of the things that we did not enjoy writing about in ProSales when stock building supply collapsed was the going into Chapter 11 and canceling a huge number of leases. Sometimes they were sold as they were sold in a sense by stocks people to the people whose companies they were buying as being annuities. They were setting up 10, 15, 20, 30-year deals and promoting the tax advantages of doing that. And then these people, after stock collapsed, found themselves without that. And I'm wondering whether that experience burned anybody that you've been talking to these days and made them shyer because they remember what happened to their friends who sold the stock more than a decade ago.
Yeah. Well, I'll just quickly comment because we get that real estate question from every client. And, it's funny, some want to own that building. They have a lot of pride in it. They like that annuity. And others will say, nothing scares me more than owning this place if I don't own the business that operates in it. So they want to have nothing to do with it. So I think there's a diversity out there. Any other specific comments in terms of, have you seen that specific incidents or
no,
that
I think
risk?
that
Is that risk a factor?
I think it was a lesson learned for the industry that, sometimes they were adding money maybe to the leases to inflate purchase price,
Right.
And that's just a bad practice, and it just shows that it was a risky practice. So we certainly don't do it. I don't know anybody that really does anymore. I think everybody deals with real estate straight up.
Yeah, I actually, have some personal experience there. My former business was Woolahan Lumber Company up in Michigan, and we sold the business in 2006, but before that, in 1999, we actually sold 6 or 7 yards in Wisconsin and Illinois to stock, and when I think it was 2009 when we got 4 or 5 of those leases back, and of course at that time we thought it was the end of the world, but really it turned out okay. We had generally good properties. Some of them continue on. In fact, LT leases one from us in Plover, Wisconsin. I say us, it's still a family business that I'm a little bit involved with. But as far as the ultimate disposition of those properties, I would say we were able to come out okay, even though in some cases it took a couple of years. I learned a lot about how bankruptcy law impacts leases in real estate.
I bet. Well, one other key aspect of the Trump administration, and some of the rhetoric has softened on it a little bit, but some of it has remained pretty on point, that there's a desire to repeal the Obamacare and the Affordable Care Act. So how much time do you spend wondering about that? I'm not going to say pro-con, just do you wonder about that? And if it were to be repealed, how would that impact your companies and that you're holding? Is that a positive thing? Is that a negative thing?
None. We're too big to have anybody use it anyway. So we take care of our people. We would never put them in a situation where they'd have to use substandard insurance anyway. So I think it's a non-issue for us.
Okay.
I think it's more of an issue or an opportunity for smaller companies who are more impacted by it. I think it'd be great for those companies to be able to see some improvement in that area. And it's certainly, if that happens, it improves your bottom line, which increases the value of the business. So I think it'd be a great thing.
I don't really think it has any impact on us. I mean, obviously it could impact a little bit on the benefit side, but my personal opinion is I wish Trump would start somewhere else. I think that's a little bit of a tough one, but he's made some promises, and I think we're going to see what happens.
No impact that we're expecting. Can I make a comment on the real estate piece real quick? You didn't ask for my opinion.
I'm sorry.
That's all right. Sorry.
I'm so sorry.
No,
sorry about that.
I
just did that to show there's no favoritism.
That's all right. No, on that particular issue, I want to make one point, which is if you're selling your business and you're keeping the real estate and you're leasing the real estate to the new buyer, you're now a creditor, right, of the new company. And so that means you should have a lot of interest in the balance sheet, right, the credit worthiness of that new buyer, right? And so number one, I'd say most importantly, you should understand the leverage, right, that buyer is taking on in buying your business, or that the entity, the overall owning entity of your business has. What's its balance sheet look like? And I will tell you that I think that's not to be too self-serving, but I think that's one of the advantages of selling to somebody that's in the industry, somebody that focuses in building products, or somebody that's a strategic buyer that's in the industry. Why is that? That's because private equity firms, long ago called LBO shops, buy businesses with, largely with a strategy called a leverage buyout strategy. It means you take on a lot of debt to buy businesses. So if you're selling your business to a private equity firm who uses a lot of leverage in buying your business, you've got a creditor with a lot of leverage on their balance sheet, right? Businesses that are in the industry, whether they're strategics, whether they're a firm like ours that focuses in the industry, understand the cyclicality of it, tend to be more moderate, more conservative in the use of leverage, tend to have less leveraged balance sheets. You want a creditor with a less leveraged balance sheet, I would argue. So just something to keep in mind. Sell your real estate, lease it. You have an interest in the credit worthiness of that business going forward now. So.
Great. I have one more question, and I know Marisa has one more question. Do you have a preference for buying companies that are already performing at the level of the rest of your companies, or do you have a preference for buying companies that may be underperforming that you can then hopefully bring up to the level of performance that the rest of your businesses are at? So humming along well, or fixer-upper?
Yeah, we typically don't, we don't buy into turnaround, plans. We think we buy into the teams, and if those teams are truly great teams, they've probably already done the things they need to do to turn the business around. So we really focus on partnering with the best teams possible. Businesses are generally run well. They manage their balance sheet, their working capital. They have good relationships on the sales side. And then we look to see what we can do to augment that and what they bring to us. So we typically look for just really well-run businesses to partner with us.
I mean, we're really similar in that regard. We love when we partner up with a company that's doing it better than us. That just is that much more that we can learn and export to other companies within Kodiak. But as LT said, same way, I mean, we love being able to partner with someone and work together on making the business better as well.
We've done both, and I think they both have a place, at least for us. The thing is, if you have too much turnaround going on, and it becomes difficult on your team because you can only be so many places at once, and the workload can be great in some cases. So we try not to have too much turnaround in any one time, any one year, but when we do, we look at the acquisition differently. Certainly, we look at it much more in terms of what kind of assets are we buying, and then what can we add to the business. And we've done some very transformative things to businesses that we've acquired, where maybe they had a major need for capital investment in their stores or in their facilities, and we've really seen that make a huge difference. I mean, that would be another point I would make, is that there are different types of turnarounds, right? There's some that are, where a business has really kind of damaged its brand equity in the market. That's a tough one. We would stay away from that if we were able to realize that. Others are more where the brand still has some strength, but they just need that injection of capital, whether it be in the facility, or in some cases it's simply a matter of getting back in stock, putting, and then the business kind of reblossoms right from there, and that can be a very attractive from a financial return standpoint.
Interesting.
Generally speaking, we're looking to buy good or great businesses. So the better performer of businesses, the more interest we're going to have, the more we're going to be willing to value that business. I'd say exceptions might be, talked about focus some earlier. Some operators have a track record of success buying underperforming businesses and improving their performance. And so if we're in business, if we're partnered with an operator who's got a track record like that, then we'll support them in doing more of that. But absent an operator who's got a track record of success in doing that, our general kind of MO is we like to partner with proven operators, talented operators, buy great businesses, and look for incremental improvement.
I think it can also make a difference too if you've already got a presence in a market, and there becomes a add-on acquisition that maybe isn't as strong as what you are, then you can take that on, and it's a fairly easy process to turn it around, if you will.
Makes sense, yeah. Was there another question from the audience?
I have about 7.
Give me the time, we'll cover them. Yeah.
One of the questions is, can you talk past the value of a transaction in terms of cash flow? How many do you pay all cash up front versus earn-out or stock?
Go ahead.
We've done all cash. We've done 90% with 10% reinvested. It just depends on the time and the willingness to reinvest. I can say that, people that we partnered with in 2010 not only got what we paid for the business, but they probably made more by investing in USLBM in the last, 6-7 years than they did actually selling their business. So I think it's really what you want to invest your money in and where you want to be. But, we'd like to see owners invest in our business to show they believe in the model and they believe we can, that together we make a better business.
Yeah, we really tailor each transaction to, the needs of the seller. And so in many cases, like LT said, we've had investors or sellers that have become investors in Kodiak. In fact, our 2 guys that still work with us today were in our very first transaction that launched Kodiak that invested 100% of their proceeds in Kodiak, and they're pretty happy guys today. But we really try to customize the situation to your needs. So, sometimes, and in many cases, we've had sellers that really wanted to be a part of Kodiak, both day-to-day operating, want to be invested in it, and we love that. And collectively, we own about 25% of the company together. But then in other cases, that's not a dynamic that's going to work for that family or that ownership group, and we've tailored different transactions and structures to, for it to be 100% payout on day one.
We've done different types. Early on, contribution of assets in return for equity was how we kind of got started, but mostly cash deals. I could think of one case where we did an earn-out acquisition, but we've actually used just kind of straight-out seller financing for a period of time as well, where we pay a portion of the purchase price over time.
Like these guys said, transaction structures vary. I think we're all set up to be flexible to sellers' needs, all else being equal. The more the more a seller keeps in the business through seller financing, through equity, through being landlord, that's a positive for us. We're very much focused on interest alignment with the people that are important in driving the future value of the business. In theory, if you had a passive owner who's not involved day-to-day in the business, who we believe is not integrally tied to the future value of the business, we'd be less insistent upon some portion of purchase price rolled over into the business in the form of seller note or equity. But when you've got a selling owner who is very involved in the business, maybe has a less robust team around them, I'd say the need for alignment of interest going forward increases. Like these guys have said, that's rolling over equity in a business is both a positive and negative. It's a negative because you're not getting that cash up front. It's a positive because what are you going to do with that cash, and where are you going to invest it? And in this returns environment, and with the opportunity to invest in an industry, in a business, I know these guys, investors or sellers who have rolled over equity have done tremendously well. Ours have as well. Knock on wood, and hopefully that'll continue. But certainly, all else being equal, the more a selling owner keeps in the business, the more favorably we're going to view the deal.
And I apologize, I didn't know that some of the audience questions had backed up. That's the disadvantage of not seeing the hands go up. I'm sure the panelists would be happy to take any of those questions afterward, and want to thank them again for taking the time to come and join us. And thank all of you very much.
Thanks, guys.